we'll be doing a session on technical analysis. If you're very new to trading or investing, do not worry, it's going to be quite basic in terms of understanding the fundamentals and getting your foundations correct when it comes to technical analysis. If you're already an advanced technical analyst or you've already been trading and you already know about the markets, hope this adds more value to the knowledge that you already have acquired. So today specifically we'll be looking at how to identify trends when you look at a chart. So technical analysis is mainly something that you do when you look at a chart or you look at the price action on candlesticks or a line chart. So I'll get into more of what a chart would look like if you're very new to the trading or investment side of it. But if you already had any experience, please bear with me as I just go through the foundations of technical analysis on this webinar. So there are two, three different types of analysis a trader or an investor would do before he takes any kind of investment or trading decision. The first one is fundamental analysis. The second is technical analysis, and the ones who are more sophisticated they also go into quantitative analysis. Now, a very short description of what a fundamental analysis would look like is, let's say, for example, you want to buy Apple as a stock. Now, when you want to do a fundamental analysis of Apple, you will look at what the company is all about. What is the product? How have they been performing over the years? How have they innovated their products and how are the sales growing? How are the revenues growing? How is the company growing? So, looking at the profitability of the company and the business model that the Apple operates under, these are the analysis. You look at the financial statements and quarterly earnings of Apple for the last 5 years, 10 years, to understand the growth that Apple has been doing. So that now you're confident that Apple is a good, strong, fundamentally strong company that you would like to invest in. Now, this comes under fundamental analysis. But when you look at technical analysis, yes, you do fundamental analysis. You're part of fundamental analysis in terms of understanding what you're investing in. For example, Apple is a stock, and you will need to know if Apple is a good stock that you should be looking at buying or trading, or if you want to invest into Apple for the long term, you need to have an understanding of Apple for sure. But when it comes to technical analysis, now that you've identified Apple is a good, fundamentally strong company, you use technical analysis to identify investment opportunities or trading opportunities, or you look at technical analysis to understand at what price would be a good level to buy Apple, or at what price would it be good to sell Apple. So, for those of you who are doing long term, technical analysis still plays a very key role. I will show you a couple of examples of how you can add technical analysis to your fundamental analysis to make an investment decision. However, those who are looking at short-term trading or those who want to do a very intraday based trade, or someone who's looking at trying to take the momentum of the daily move or the weekly move, technical analysis is going to help you a little bit more than fundamental analysis. Why would a technical analysis help a short-term trader more? I mean, how would a technical trading analysis help a short-term trader more? The reason being, Apple, although we know is a good, strong company or fundamentally strong company, Apple also has its down days. And on those down days, a short-term trader would take quick advantage of trying to take advantage of the discount that is getting for the day and not looking at a 5 year view or a 1 year long-term view. And in this case, a technical analysis would be more suitable. However, you still need to understand that fundamental analysis is key, that you need to look at what is happening in the news. Is there any specific news that has come out for Apple? Is it because of that news Apple is down, or is Apple down just because of the overall sentiment in the market for the day? So fundamental analysis does play a key role, but then technical plays a much more important role when you have to make a decision for short term. Now, I hope you've understood the difference between technicals and fundamental analysis. Please feel free to keep typing in the chat if you have any questions as I'm going through this presentation. And I will look to answer all your questions during this time that we have for this webinar. Now, very basic charting. I'm sure all of you all would have learned charting at some point in time in life. So this is a line chart. Clearly, it shows at what prices SPX 500. In this particular example, we are looking at US 500. For those of you who do not know what US 500 is, it is the top 500 stocks. Put it into one basket. So instead of me looking at all the 500 stocks in US today, I will just directly look at the SPX 500 and it tells me how SPX 500 has been performing for the day, for the week, for the month, or even probably for the years. And this how a line chart looks like. Now, most traders often prefer using a candlestick chart. Pretty much, a candlestick is represented by a body and a tail. Now, if you look at this particular green color candle, what it shows you is the body contains the open price and the close price. So, what does an open price and a close price mean? Let's say, for example, there is a stock that is trading at $100 as of today, and the market opens at 6:30 Dubai time. Now, of course, 6:30 Dubai time is morning for US, so the US market opens in the morning. But for us who live in Dubai, it opens at 6:30. Now, let's say the price of that particular stock opens at 100, and during the day it goes down to 90 from 100, and then by the close of the day it actually closes at 110. So in this particular example that you're looking at, the open price will be 100. The tail that you see over here is the price where it went down below the open price. That is the low which made 90, and then eventually when it closed above at 110, that makes it a green color candle. And vice versa for a red candle. If it opens at 100 and closes at 90, the body shows you the open price and the close price, and that becomes the body. Now, in between the open and close, maybe it opened at 100, it went to 115, but then came back to its open price. It went probably as low as 70, but it closed at 80 or 90. So the tail always represents the high price for the day and the low price for the day, whereas the body represents the open price and the close price. And the color represents whether it opened lower and closed higher, or it opened higher and then it closed lower. So, and this is how the candlestick is formed. I will show you a couple of live examples as well. If you're very new to understand how it is working, it will give you a much more clearer picture. In fact, let me just share my screen with the chart right now. I'm going to open SPX. Now, this is how the candlesticks are formed. Now, few criteria that you need to look out is, one is what instrument am I looking at, and what time frame am I looking at. I'm looking at a daily time frame. Now you can choose your time frame. You can look at a 1 second time frame, 5 second, 10 seconds. Now, how does this time frame help us? When I'm looking at a daily chart, let's say I'm looking at a daily chart, each of these candles represent every day's move. For example, let's look at what is happening today. This is the live price that's happening on SPX. Now for today, SPX actually opened a little higher. Let me put my cursor on. SPX opened at 3966 roughly, and currently now it is trading lower at 3913. So it's trading almost six 3966 is trading almost 50 $60 lower than where it has opened, and hence it is a red candle. Now if you look at this particular green candle here, this particular candle opened at 3750 or 3749, and it moved all the way up and it closed at 3965, and hence it is a green candle. So how would I read this particular candle? I know on the 10th of November the market has gone up because of looking at the green candle. Now let's see what happened on 11. We have a green candle. Price did move up, but a very minimal move. What happened on 14th? Price moved up, but it eventually closed lower, so hence it is a red candle. Now remember the tails are the high. Like let's look at this particular candle. It opened low, it went as high as this level here, and then it again came back low and closed a little higher than where it opened. So although it came back down, it has closed above its open price and hence it is a green candle. So I hope we are clear on the candles. Let's just look at a 1 second candle. Just to repeat myself, when you're looking at candlesticks, each candle represent the time frame you're looking at. So in this case, it represents every single day that the market has been trading. Now let's look at a 10-second chart. Now every candle will represent only 10 seconds. This was the previous 10 seconds, this was the previous 10 seconds. So as you keep going behind, this is at 7:11. This is at Sorry, this is at 7:11 10 seconds. This is at exactly 7:11. This is at 7:10 50. This is at 7:10 40. And every candle represents 10 seconds time frame of the history side of it. Now let's look at what is happening currently. We are looking at a time frame right now. It is 7:14:40. Now the next 10 seconds has opened. You can see the price movement. It's opened higher, going low. It closed slightly higher, so hence it's a green candle. Now this is the next 10 seconds, which is in operation right now. It has opened at this price. It closed at this price, so it's a green candle. So there is a lot of significance with each candle, which we will probably do in our further sessions when we're doing candlestick patterns. But for us to understand how candles work, this is a good example. Now let's go back to support and resistance. Now that we understand how charting works, of course, we also how the line chart looked. So you can see a line chart looks like a ladder. It is slowly climbing up. Now, what does this show us? When you just look at it visually, even if you're very new to trading or investing, this shows an uptrend that is happening here. So that is what is going to help us to understand the trend in the market. Looking at past historical price waves, as we may call it, or price moves, you will look at how the price has been performing. Now, in this example, you will see the price moved up, and then you see a sudden drop in the market, and then you see the price move up again, and then you see a drop again. So, what happens is every time it moves up and the spot it drops down from, it it means there is some sort of resistance. It is not allowing the prices to move beyond that, and hence it took resistance and it dropped back down. And every time the prices move back up from a certain point, it is known as support. So very simple, support and resistance is when the prices bounces off a specific price. It can happen multiple times on the same price, or it can happen 1 or 2 times. The more the time it jumps up from the same price, it is known as a very strong support. Now in this particular example, it is just shown to tell you what a resistance and support might look like. But if you ask me if this is a strong support, I would say no. But if I had to see the same price coming back multiple times, then I know it is a strong support. And I will explain to you what the psychology behind a strong support is. I hope everyone is following me. I think there's a question. Can we say the fundamental analysis for investment while technical analysis is for trading? Yes, that's right. So you could say that. Of course, like I mentioned to you, fundamental is still key for even short-term trading, but you can interchange both. The weightage that you give for each analysis depends on whether you're doing investments, then you're more towards fundamental analysis. If you're doing intraday trading, you're more towards technical analysis. Now, plotting support and resistance, one point that I forgot to mention over here, trade the bounce. is a term that the market or traders use, or trade the break. Now I'll show you a couple of examples what it means. So in definition wise, it says buy when the price falls towards support. Like told you earlier, let's say this was a support price, market went up, and if it comes back towards this price, I would look at buying. Now, of course, that is not just one indication because it has come back to the same level I need to buy. You need to have at least two to three other confirmations before you take any investment decision. This is one of the signal or one of the criteria that you can use to certain parameters before you take a decision. Sell when the price rises towards resistance. Example, you bought at this price and you see there's a resistance over here. Probably multiple times it has gone to this price and it's been dropping. You know, if you buy here and it goes back to resistance, that is where you sell, or that is where you take your profit and you exit and wait for the next opportunity. Now, treat the break is slightly different. I will show you with live examples so that way it will be more easier for you to grasp. Now, in terms of support levels, indicate where there will be surplus of buyers. So this is the psychology behind every support and resistance. Why does a price often, let's say for example, there's a stock that is trading at $100 in this example. Let's say the price of the stock goes up to 120, and maybe the next day it comes back to 110. 2 days later it goes back to 120 again, and maybe a week later it comes back to 110. Then you see it bounce back to 115, and the third time, probably 2 weeks later, it comes back to 110. Now you see there's a psychology that is being built at 110. Every time it is coming down to 110, you see the prices bouncing back up. This is because all the buyers or all the investors who feel that the price of 110 is a fair price at this point of time are putting their orders or are willing to buy that stock at 110. Nobody is waiting for it to come back to 100. Now everyone's willing to pay 110, and hence every time it is coming to 110, opportunity is being taken. So eventually the market is not going to trade in a range. It's not going to be trading between 110, 120. Maybe a year later, the same stock, which was taking good support at 110, maybe now might be trading between 150 and 200. So every time it comes back to 150, you see the prices bouncing back up. So in this case, 150 becomes your next support. Now, however, if it breaks below 150, then you could still wait for 110 for you to buy more if you already bought at 150. I hope I'm clear on this. And if I'm going too fast, please let me know in the comments. I will slow down. Plotting support and resistance. Like I mentioned to you, this is SPX chart. Again, this is an example taken on a 5 minute chart. That means each of these candles represent a 5 minute move. Now, in this case, the prices went up, it came down a little bit here, the prices went up again. There's a second time, again, we see a very big drop. That means every time it is moving to these prices, a lot of selling is happening. So, for those of you who do not understand short selling, do not worry about it right now. But just assume that when the price goes up to these levels, people are booking their profits, hence, the prices are dropping back down. And then eventually it has picked back up. This is the third time it has gone to the same price, it drops again. And then it has gone there for the fourth time and it drops again. Now, one of the rule that most traders, at least most of them, try and follow is before you say this is a good resistance, you always wait for 2 to 3 confirmations. In this case, there was one, there was two, there was three confirmation. So the fourth time, you can expect the market to behave similarly because it is a good resistance where people are not willing to uh, go beyond it. In fact, they are booking their profits and they want to exit their position or sell their position. And for short sellers who understand short selling, this is a good short selling opportunity. For those of you who do not understand short selling, I'll put it in very simple words. It might be a little confusing at this point of time, but you can please watch a YouTube video or any videos which gives you a good explanation of what short selling is. I will make it very simple for this session. Short selling is instead of me buying, I will directly click. So you have a buy ticket, buy price, you have a sell price. I just click on the sell price and I take the trade. In this case, if the price drops, I make money. If the price goes up, I'm going to lose money. Okay, just keep that in mind. Do not worry about how it works. What is the whole mechanism behind it? It is going to take a lot of time to grasp how can you sell something that you haven't bought. But in this case, when I mentioned short selling, just keep this in mind. When you short sell, if the prices drop, you make money. When the prices go up, you lose money. But when you buy, you also people also use the terminology, you take a long position. For that means you're buying. Whenever you buy, if the prices go up, you make money. When the prices go down, you lose money. I'm sure everyone understands buy easily. Short selling is a bit confusing. Now if you look at, hear me, I'm so sorry. If you can hear me, just please send me your message in the chat. Okay, thank you. I think everyone can hear me. Again, my apologies. I think there was some technical glitch. My voice went off. I think someone asked me if there is a break. Sorry, we are not keeping any breaks because it's going to be a very a short 1 hour session. I hope you're still with me. All right. So now we understood how a support and resistance looks. Of course, now this chart makes it look very simple. It seems like every time you identify this pattern, it's a good profit making trade. Not always the case. I will show you what are the challenges that we may face when we find these trades and how you can avoid making a very big loss on a trade just because it has happened over and over again. It is human tendency that we gain confidence because of the price movement that has been repeatedly happening. It is not always the case. History repeats itself. There are a lot of factors that influence these price movements. We should keep all of that in mind before taking any investment or trading decision. So the key at the end of this session would also be is, irrespective of how good the strategy or how good a technical analysis might be working for you, the key for a successful trader or an investor is how you manage your risk. Now I'll get to the managing risk part, which is the most important part later on. Let's look at a couple more examples on support and resistance. Now, what we saw earlier, in this case, you're looking at this sideways movement where the price is just trading in a range. Right now, this looks really good where you can just buy sell on every level. But what if it is not always the case? Now in this case, you don't see the price going back to the same level. Or let's look at an uptrend market where the price is going up, it comes back low, but it does not come back to the previous low. It makes a higher low and then it makes a higher high, and then it comes back lower and it makes a higher low than the previous low. So whenever you see it make higher lows, and if you can connect three of these levels, it automatically gives you the trend, and that is where your trend is identified. Like people say, trend is your friend, always be with the trend. In this case, now after you get a three confirmation or 3 points have been met, the fourth point onwards is where you can potentially take an investment or a trading call. Now, in this case, if you have to take a trade on the fourth confirmation, it would have given you a decent profit. If you did not exit, it came back down. You could have entered again. And then, of course, after this, we'll see what has happened in the live chart. And this is how a trend has been identified. So identifying these trends is not too much of a challenge. It is pretty simple. Just follow the basic rules. We need to connect 2 points when you see a particular pattern appearing. Now, of course, before I drew this line, I saw the pattern. Every time it came down, it is making a higher high, sorry, higher low, and of course a higher high as well. In this case, every time it came down, when it went back up, it did not make a higher high. It made a higher, sorry, lower high, and it made a lower low. So this becomes the downtrend. Of course, keep the visual in mind. It solves most of your problems identifying trends. You do not require a line, but the line is required for you to understand at which point in time that you can make a investment or trading decision. Moving forward, now the same concept, the very basic foundation that you all just saw. Now, there are patterns that form in the market mainly because of a lot of psychological levels in the price movement. It is always the pattern appears when there is a tug of war between the buyers and sellers, right? So, if you see the price coming lower and then bouncing back higher before it touches the previous low, that means there are a lot of buyers who are willing to buy at a higher price. Whereas when it goes back up, you see the price immediately start to drop back down. That means a lot of sellers or short sellers who are willing to short sell or sell the market or sell their position. So hence the price comes back down. So all your price movement is on basic supply and demand and how the buyers and sellers behave in the market. Now, identifying these behaviors, of course, we do not know who's behind the screen, who's doing what, but looking at the chart patterns, you will clearly be able to identify where the buyers are taking the price into consideration and where the sellers are taking into consideration. And these patterns, what we saw earlier was trend lines. This by itself is a trend line here. This is making a downtrend, but in the same downtrend, you can see there's also an uptrend that has begun. So, hence, this is known as a symmetrical triangle because the angle at which it forms is symmetrical. And every time you see it break above either lower or higher, it is known as a potential breakout. Now, how in traders use this particular pattern is they identify patterns, and once the pattern gives a breakout, that is when they take the action. Now, in this case, a trader would take an action once this breakout has happened, and of course, we need to keep stop losses no matter what or how good the trade could be. And of course, once the prices go up, you keep your take profit. I will also show how take profit and stop loss needs to be considered. We cannot just randomly choose a take profit and stop loss. There has to be a very good logic or a very good technical reason for us to choose a stop loss and take profit as well. These are different types of patterns. Again, I will not get very deep into it, but this is just for your understanding of how the patterns appears. This is inverse head and shoulder. I think proper head and shoulder makes more sense. So whenever you see one triangle, the bigger triangle is higher than the previous one, and the third triangle is similar to the first one. Now this makes up your shoulder, and the top one makes your head. So hence it is known as the head and shoulder. Of course, the name is derived based on how the patterns look. Now, in a head and shoulder pattern, which pretty much often occurs also and works out really well, as long as it has been followed very carefully and the identification of a head and shoulder is accurate. For accuracy, it's very simple. You follow all these parameters. You make sure the shoulder align itself next to each other. The head has to be higher than both the shoulders. And this line, the blue line over here that you're seeing, is known as the neckline. So, and the neckline needs to be pretty much on the same level. Slight up and down is not an issue, but it should not have a very big variance. Now, every time it breaks below this neckline is when you can expect the prices to go down, and vice versa for a reverse head and shoulder. Every time it breaks above the neckline, you can expect the prices to go up. Now, people who trade only on head and shoulder patterns, they take a buy once it breaks above the neckline. They keep a stop loss below the shoulder and they keep a take profit as big as the head. Now, let's say this head is about a 10% drop. They'll keep a take profit of 10% on the higher end. So, and that is how a head and shoulder pattern is traded. Now, of course, every pattern that you see here has its own way of taking, but I hope you all understood the underlying idea of how these patterns work. Of course, you can do more in-depth analysis on if you're following head and shoulder patterns, what are the exact criteria that you need to look at, and if you want to trade it, how can you keep stop losses, take profit. You can go more in depth into one single pattern, but for today we are just going to brush through all of these patterns. This is known as a cup and handle. Obvious reason it looks like a cup. There's a good U shape movement that is happening here, and a small U. So the small U should not be 50% of this entire upside move. And then when it gives you a breakout, again it is known as a good breakout trading opportunity. You take a buy, keep a stop loss below the handle, and your target will be as big as the cup. Let's say in this example, let's say this cup is a 10% drop here. You can expect the prices to move up by 10%, and your take profit and your stop loss has been determined. In all the cases, take profit and stop loss is not determined in the same way, but most are with the similar pattern. And I'm sure by now you will get a very good idea of how it is done. Similar patterns, these are patterns which is trading on a sideway market, breakout on the upside is a buy, breakdown below is a short sell. This is a flag. It is known as a flag because if the price moves up and makes your waves on the lower end, it happens to look like a flag, and hence the name has been given. And if it's on the upward move, it is known as a bullish flag. If it's on the lower move, it is known as a bearish flag. Of course, I'm going to show you a couple of examples on the live chart so that we'll be able to identify these charts. Hopefully, we get a couple of opportunities for us today as well. And I think everything else is self-explanatory. If you all have any doubts, please feel free to write it in the chat. Let's go to the most important part. Now we've understood how candlesticks are formed. We understood what technical analysis can be used for, and we understand how to identify your support, your resistance, how to identify whether it is an uptrend market or a downtrend market, and how support resistance form different patterns that you can look at to take advantage in the market. Now, keeping all this in mind, the most important thing is how do we understand where and how much should you be buying? One, if you buy, what how much of a movement can you expect? Let's say, for example, there is a stock that trades at $100. Now you see it has come at support based on one of the analysis that we just looked at, and you want to buy the stock, and you want to understand how many dollars you want to keep as take profit. Let's say the stock is trading at 100, and you want to know for today, if I want to take advantage when the prices go back up, how much profit should I book. Now, of course, looking at the historical data, you can manually calculate. You will see yesterday it moved up and down by $2. Maybe last week it moved up and down by $10. Yesterday or day before yesterday, it moved up by only 50 cents. So now you do not know on an average how much it's going to move, and that is where average to range is going to help us. I will show you a couple of examples so it will be easier for you to understand as well. Now, once we go into a platform, again, there's an example of S&P 500 on this. I'm looking at a monthly time frame. That means each of these candles show me monthly price movement. In your chart, you have technicals at the bottom. Once you click on technicals, it comes to a lot of technical down here. Do not worry about it. We will cover more technicals probably on one-on-one session if you all need more training on technicals. You go to studies, you click on studies, and you come to ATR. ATR again stands for average true range. So once you click on ATR, this is the line that opens up. Now, what is ATR telling me at this point of time? ATR is telling me on a monthly time frame. That means each candle represents a month. On a monthly time frame, how much does US 500 or SPX 500 move? At this point of time, it is showing me in a month I can expect SPX to move almost $339. So that means if I'm buying SPX today, I can expect SPX to move $339 on the upside, or I can also expect the SPX to go against me by $339. Uh, Very important point to note down over here is it does not tell you the direction of the market. It only tells you how many dollars SPX can move in a single month. Now, let me show you. Okay, I think in terms of the presentation, that's about it. Let's go to the practicality of it. I'm opening SPX here. Now, this is the live price. SPX is trading at 3,920. I go to technicals, I go to my studies, and I click on ATR. Okay. Now, let's look at ATR. Let me make the screen bigger so it's more easier to see the prices. I'm just going to be hiding all the technical tools. Now, can you see the ATR over here? It says SPX in the given month can move about $373. So it can move up $373 or it can move down $373. Let's go back in history. Let's look at how many dollars it used to move in 2020. In 2020, SPX was moving. You can look at the prices on the right hand side over here where my cursor is. It was moving only $264. So if I was trading in 2020 and I happened to buy SPX and I aim for SPX to go up in a month by $600, it would not make sense because the average move at that point of time is only $260. Similarly, right now, let's say if I buy SPX and I'm expecting SPX to go up this month or probably in the next 1 month by $1,000, it would not make sense because SPX moves only $360. Now, because I have this information, it makes it very easy for me to understand if I'm going to take a monthly trade all I can expect SPX to give me, or if it does go against me, would be in a range of $350. I hope the ATR is clear. Now, let's say I change the time frame to a daily chart. Automatically, my ATR calculates on a daily moment how many dollars can SPX move? So on an average, SPX can move about $90 a day. So that's a good decent move. I feel if you're getting a $90 move every single day, you can take advantage by trying and capturing maybe 20% of the move. Maybe you're trying to capture 15 to $20 move. Of course, no one will be able to capture the entire move because by the time you identify the signal and get your confirmation, the price would have already moved in your favor by a few dollars. So hence, you can't expect to make a $92 every single day. But since I have this information, I know SPX can move $92. I look at what is happening today. What exactly is happening today? I can see SPX is down by $48. So this tells me that SPX could have some more room downside because its average movement is $92 and it has moved only $50 for the day. So it has 40 more dollars move it could potentially move for the day. Or at the same time, SPX could go back up by $45 and close up by another $45 as well. Now, like I mentioned to you, the ATL does not tell you the direction of the market, it only gives you a sense of how many dollars SPX can move. Now, let's use our remaining technicals that we have learned to see if we can find any support and resistance. So, now to make it more easier, I'm going to change this into a line chart so it's more easy for you to understand support resistance. Now we can see over here, let's say I'm going to put my line here. That looks like a good support. Uh, Once upon a time, it was a resistance. It came, it went back above that. Now it can take a support there. Now I can see a couple of supports here. Okay, you can see the prices came till here, bounced up. This time it broke a little bit, took resistance, broke down, bounced back up. So this is one easy way for you to draw support and resistance. Every peak and every drop that you see, all you need to do is put your lines there. Okay, now I'm not going to go back way into history. There are a lot of supports and resistance. Since I'm looking at a daily chart, I think last couple of days is good enough to look at. Now I go back to my candlestick chart. Now let's look at what has happened in this particular chart. You see, can you see the candlesticks? Okay, let me make the same chart. Now I'm going to make from 1 day into 4 hours. So every candle will represent a 4 hour move. Let's look at a 4 hour move. Now you see the price went up, dropped, went up, dropped. If it had to come the second time, the third time would have been a good buying opportunity, but it did not. It went up. Now it took resistance, came down. This time it did not take resistance, it has broken up. Now, if you look at this, it has given me hardly two times confirmation, so I would not be very confident of taking any buy or sell on these. So this is on your horizontal support and resistance. Now I hope you all have understood that. Now let's look at our trend line. What is the trend looking like? Without me drawing any line, I can see market is going up. It gives a drop, makes a higher low. Even here, it made a higher low, went up, higher low, came down, higher low than this. Again, it's gone up. So it is making higher lows. So what I would do is I will connect my lower points, starting from the lowest point. Now beyond this, there was no other low point, so I will start from here. I cannot start from here because this was the lowest point. So I calculate my lowest point, and my second lowest point is here. Okay, now this gives me the trend. Now, although the market is down for the day by 50 points or $50, the overall trend, or at least the short term trend, is still more towards the upside. So this tells me that the trend is intact. It has not broken below. I would say the trend breaks is broken only once it starts falling below these prices. Let's say it starts dropping below this. Now this is where I would expect my trend to be broken, and if I have taken a buy, I would have to be cautious. Of course, that's where a risk management will come in. Now let's look at if the price comes to this price, is it a good buy? Now I can always use my horizontal lines. Okay, I will extend this to, sorry, extend left. Okay, now my line has gone back. Now let's see if this particular point where both the lines, my horizontal as well as my trend lines, coincides, if there is a good support. Now I go back to my line chart, and let's just go to a daily chart. Now let's look at historically if there is any price action that has happened around these prices. If I look at it, it has given a lot of price action around this particular price. So this gives me a second confirmation that a lot of buyers would be at this particular price. Now, if I change this back to my candlestick, you will see previously there was a sharp pull up from this price, then there was a breakdown below that price. Okay, and it was taking resistance. So that means this particular price is acting as a very good resistance as well as support. Then it breaks above the resistance, it comes back to the support, breaks below. So you can see a lot of action happening, especially on this price. Now, I did not look at these prices before identifying this trend, right? This trend has happened today. Like this happened on 10th of November. This is 11th. We are at 17th. And this happened on 13th of October. These price movement had nothing to do with the previous price movement. But when we see there is a good price action that is happening at this particular price, now we know this is a good opportunity for us to enter. Now let's look at how many dollars lower that could be for the day. From here, if it comes down to this price, wow. So that's almost about $80 more. So for the day, we have $50 downside, and we could expect another $80 on the lower end. But looking at the previous trend, maybe it might not come down to touch my trend line. So in this case, what I would do is I would take a buy when it comes down by probably another $40. Why another $40? It has dropped down by $52 for the day. Another $40 makes it $90. And why $90? Because that is what my RSI is showing. So when I'm getting a price at $90 lower today, that means the average move for the day could have potentially be over. Second, you also have your support and resistance that is giving you an uptrend. Most likely the prices could go back up from here. And of course, now since I'm looking at a daily chart, I can expect the return probably within the next couple of days. Sometimes on a daily chart it could go sideways for a couple of days before it gives you a bigger move. Now if I look at a weekly chart and I go to my technicals and I select ATR. In my weekly chart, it shows me that the price can move about $200. So if I'm taking a trade on a daily chart today, let's do a trade from this level. Let's say I have $100,000. I'll probably invest maybe $25,000 in the top 500 companies of US. My take profit based on weekly, it can move about, let's make this round figure so it's more easier for you to identify. Let's say I buy 10 units. 10 units is worth $39,000. 39 into, sorry, 10 into $3,900 is your investment value. Now, as per SPX, it can move up about 200 points or $200. Sorry, that is 2,000 points. Okay, so we are expecting SPX to go from 3,915 to 4,115. So that's about $200 up. Now, because I have 10 units, I'll make $2,000. If I have one unit, I will make $200. Let's keep it one unit for this particular example. Now we know on an average, SPX moves $90. Now I'm keeping a take profit of almost double, $200, expecting the price move to happen probably within this week or next week. Now the most important part is your stop loss. How do I keep my stop loss? You always keep your stop loss based on your ATR. If my entry price is going to be $90 lower, okay. So let's say for the day it is trading at 3,900 and 900. Let's say another $40 down. So 3,860 is where my trend line is coming. So this is the price I'm going to be buying at. I'm going to keep a take profit of $200 as per the weekly ATR. My stop loss will be as per the daily ATR because I'm looking at a daily time frame. The other way to keep your stop loss is always if you're expecting a $200 move, your minimum stop loss needs to be 100. So that way your risk reward is always 1 is to 2. Risk reward is very, very crucial. If you keep a very big risk, let's say I don't want my stop loss to trigger, hence I'll keep my stop loss way lower. By chance, for whatever reason, if it breaks below this and it goes there, you're going to be making $400 loss, and you will need another two trades with $200 take profit, and for it to go completely in your favor to recover this loss. So never have your stop loss bigger than your take profit. Although a lot of people do keep a bigger stop loss than their take profit, but these are experienced traders, or these are traders who are willing to take a bigger risk to make a smaller profit. It all comes down to what your risk appetite is, but as per industry, you always keep 1 is to 2, and in this case, I'm going to keep $100 stop loss. Now, there are a lot of reasons why this $100 stop loss will make sense. One, it is below my trend line. That means I'm expecting this trend to continue based on historical price movement and based on historical behavior of the buyers and sellers. And if that happens, it should go back to my target where I will make my $200. But in the case it fails and it goes below that, I am exiting my position with $100 loss because now my trend line is of no value. It has broken my trend line, and now we could expect it to come down lower. And probably it might form a new trend line, maybe a new support, and you can re enter the market and next support and next trend line. But always make sure you have your stop loss. Now, for those of you who want to do short term trading, If you're going to be keeping your stop losses, you can always increase your risk, increase your position size based on how many dollars you're willing to let go of on per trade. Let's say, for example, I'm a trader with a very conservative risk appetite. I would probably risk not more than $400 per trade. So I will take 4 units. In that case, I'm investing about $15,000 to take a risk. Sorry. Yeah. So I will take a risk of $400. So that means if the price drops all the way from 3,860 to 3,760, that is $100 lower, I will lose 100 into 4, $400. But if the price goes to my target, which is $200 on the higher end, 4 into 2 is 4, and 4 into 200 is $800. So you make a $800 recovery. Now this is completely up to individual to individual. You could do ultra conservative, you can just do 1 unit where you risk only $100, or and to make $200. You could do 10 units if you're a little more if you're okay with your risk appetite being a little more on the heavier side. You can risk about $1,000 to make $2,000. Now in certain cases, yes, can this go up higher than this? Of course it can. But if I'm looking for a bigger move, then probably I will start looking at a weekly chart. Now, on a weekly chart, it shows that my ATR moves about $200. But remember, we also had looked at a monthly chart where it says it can move about almost $370. So, in that case, I can always aim for a higher take profit. So, 370 roughly. So that will make me a profit of $3,700. However, my stop loss still remains intact because I am not willing to take a risk below this trend line, because below this trend line, I will show you how history looks. I'm just going to close this. I hope all of you will understood the risk management. Let's look at if we did not have a stop loss on a trend line that had made earlier. Now, a trend line break or a negative market or a positive market could always be on a specific news. But when you're doing technical analysis, you always stick to your stop losses and take profit irrespective of what is happening in the news. Now, of course, now if you get the news beforehand and you know the market is going to drop and you can cut your losses much earlier, you can do that. But however, I would advise not to do that, because sometimes what happens is certain news come out, there is a knee jerk reaction in the short term, but in the long term that news was actually not that big or not that fearful. Of course, now if there is any major news, you'll be able to clearly identify it's a very big news, and then you can always exit the trade without waiting for it to hit your stop loss. But also be cautious. If you keep cutting your losses on every single news, uh, and prices go back in your favor, you'll also miss your trade. Now let's look at this. This was a good uptrend move that's been happening, or that was happening, sorry, rather. My first point and second point to draw my trend line. Market went up, second point, third point I bought, fourth point I bought, fifth point I bought. It came down, stop loss would have triggered for this. It went back up, sixth time I bought, I would have put a stop loss, would have triggered. Now I made, in this case, I would have made profit twice here. I would have hit my stop loss twice. So in a risk reward, if I had to risk $100 to make $200, here I would have made 200. Here I would have made 200. That's $400 take profit. Here I would have made $100 loss. Here I would have made $100 loss. That's a $200 loss. I'm still in net profit of 200. But let's say if I did not keep a stop loss and this happened, this is where probably before this you would have made money all the way, probably this entire rally here, everything was a profit for you. Every trade that you took went in your favor, it was brilliant, you made profit. Let's say out of 50 trades that you had taken, 40 trades have given you profit, 10 had probably given you small losses. But for those who do not keep a stop loss, let's say all the 50 trades gave you profit, and this one big drop took away everything, because eventually when the market goes against you and we do not have a risk management, that is where a lot of people lose money. So hence, risk management is a key tool that needs to be used irrespective of how good your analysis is, irrespective of how good the strategy is. Make sure you measure your risk, you always assess your risk, and then take into consideration to invest or to trade or to do short term trading. So you can do short term trading, there is no harm, but you should be more disciplined. If you're doing long term trading, again, it's a very good investment opportunity. Again, you need to have discipline. Short term traders always tend to get scared when the market goes haywire because of the noise. Long term traders usually end up booking profits too early rather than waiting for the market to give its full potential returns. Hence, use your ATR, measure how much returns you can make in a month, and hold on to those positions till you achieve those results. At the same time, for short term traders, if you have taken a trade, please make sure keep your stop losses, because if the trade goes against you and it's a drop like this, probably in this case it did recover eventually, but then short term you would be under a lot of stress and a lot of losses. A lot of decisions will be made in this drop, not based on logic, it would be based on fear, and hence you might end up losing more. And eventually you would have recovered if you had to follow all the discipline in the market, but because there was no stop losses, lot of traders tend to lose more, because every decision that is being made after that is out of fear and not out of pure logic and pure technical analysis or fundamental analysis. I have a question here, I will answer this question and then probably we can call it a day. I hope the session was interesting, I hope you all got to learn a lot. If there is anything else, please reach out to your sales executive. They can have a meeting with you. You can have a one-on-one meeting with me as well. Once your account and everything is set up, we can do more sessions. There's just a basic version of technical analysis. We have more advanced session as well. What software are you using? Is this unique to your company, as it seems to have many chart types? There's a next generation platform. Yes, we and the CMC markets pretty much use this is a CMC market platform, which again we have exclusive rights in UAE and in GCC countries for you to use the platform. And once you register with us, you will get this platform to trade. Of course, this platform has a lot more features. It has your patterns that the system also helps you recognize and identify, rather than you taking time to do it yourself. You have these patterns where the system itself will give you. I'll just show you a quick one. Asset classes. I'm just going to choose all the asset classes. All right, so we learned about different patterns. Here are a couple of patterns. Now it also tells you in terms of stars. A five star means it's a very strong pattern. So these are emerging patterns. Let's look at breakout patterns. Breakout patterns is what people look to trade on. So breakout patterns, I have a five star on this particular stock. So if I just click on this, let's see what pattern is showing. It's showing me a double bottom. So basically support, double bottoms are usually two supports, and it is expecting the prices to go up to this target. So this can be first targets, target 2, target 3, and target 4. So this helps you. Of course, do not depend on the system. It is always better for you to learn yourself, and then you know when the system gives you a signal what action needs to be taken. There's one more stock. Okay, this is only on live chart. Let me try and see if I can get anything on indices or commodities. Okay, so there is on Canada, or there's on US 30. There's a US index again. This has not given me a breakout. Sorry, that was in emerging small cap. Let's look at small cap. Okay, small cap has given me a breakout. In this case, small cap has achieved its first target already. But however, it has come back to retest this line, so you can re-enter and target higher prices. Stop loss, of course, below the pattern. I hope this session was useful and was educational for you all. Please, I would appreciate if you can write your comments and share me your feedback. I would definitely be happy to get your feedback and improve myself if I need to in any area. And also, if you like the webinar, if you like the content, please give us your feedback. And if you also can, when you have time, give us a review on Google. That would be really awesome. Thank you all so much for taking time and joining us today. Hope to see you all soon, and hope to see you all in the office. Probably when you're in the office, you can ask for me, and we could always meet one on one. Thank you so much. Have a good evening.